Hey everyone, and welcome to today's Explainer. Look, if you're anything like me, you are literally hearing the word AI everywhere right now. But when I actually sat down and looked at the data, I realized pretty quickly this isn't just some catchy buzzword. It's actually one of the most transformative economic shifts we'll likely see in our lifetime. So today, we're going to unpack all this research together and build a really structured, completely jargon-free roadmap for investing in AI stocks. To really wrap your head around the sheer scale of this, check out this projection from McKinsey. They estimate AI will enhance global labor productivity by 0.1 to 0.6% every single year through 2040. Now, 0. whatever percent might not sound like a lot at first glance, but here's the kicker. Over time, that compounds into trillions in brand new economic output. We're not just talking about a cool new software trick here. We are talking about a fundamental rewiring of global productivity with an incredibly long economic runway.
So how are we going to tackle this? Here's our quick roadmap for today. Number 1, we'll look at the AI economic explosion. 2, we'll decipher the value chain. 3, we'll decode the top AI stocks. 4, we'll lay out your beginner investment plan. And finally, number 5, we'll cover the risks and realities.
All right, let's dive right into Section 1, the AI economic explosion, and how we measure this multi-trillion-dollar runway.
To really understand where we're going, we kind of have to know where we're starting, right? The global AI market is valued at roughly $390.9 billion for 2025. This is our massive baseline. It's already a gigantic industry, which proves that AI is already deeply embedded in the enterprise world. But just wait until you see where the research says this is heading next.
By 2033, projections have this market absolutely swelling to a staggering $4.8 trillion. That represents a compound annual growth rate of 25 to 30%. You guys, that kind of sustained, high-speed growth across an entire sector is incredibly rare. It tells us something really crucial. Despite all the crazy headlines you've already seen, we are still incredibly early to this party.
And the data shows this growth is backed by real, hard infrastructure spending. It's not just hype. BlackRock anticipates an additional $5 to $8 trillion in AI-related capital expenditures, or CAPEX, just through 2030. Meanwhile, the IDC estimates AI will add a cumulative $22.3 trillion to global GDP by that same year. To put that in perspective, that is a staggering amount of value. The big takeaway here is that we are currently transitioning from the initial infrastructure build-out phase into a massive wave of global monetization. The hyperscalers, the Microsofts, Googles, and Amazons of the world, they're spending hundreds of billions right now to build the foundation.
Which brings us to a golden rule for beginners, and it's this: invest in the picks and shovels. Think back to the 1849 gold rush. The most reliable wealth wasn't actually made by the prospectors trying to strike gold. It was made by the folks selling the picks and shovels. It's the exact same thing here. You don't need to stress over predicting exactly which specific AI app is going to win out in 5 years. Instead, the research suggests you just need exposure to the companies building the foundational infrastructure that every single AI app needs to function. Okay, moving on to Section 2, deciphering the value chain, or basically understanding exactly where all this money is flowing.
Let's break this complex market down into 4 highly digestible layers. Think of it like a 4-layer cake. Layer 1 is the enablers and infrastructure. These are your chip makers like NVIDIA and Broadcom. They're the bedrock. Layer 2 is cloud and platforms, giants like Microsoft Azure and Amazon AWS, who actually host the AI models. Layer 3 is software and applications, companies like Palantir building the actual usable AI tools. And finally, Layer 4 consists of the adopters, everyday companies just using these tools to get more efficient. Now, the absolute strongest financial moats, the proprietary tech and massive scale, they're predominantly found sitting right there in layers 1 and 2.
Which leads us perfectly into Section 3, top AI stocks decoded. Let's analyze some of these market leaders. When we look at absolute powerhouses like NVIDIA, Microsoft, and Broadcom side by side, we're seeing market caps in the trillions. It's easy to get sticker shock, but let's focus on that forward PE column. PE stands for price to earnings, and it's a classic way to gauge if a stock is just wildly expensive. NVIDIA is sitting at a forward PE of around 24x, and Microsoft is at about 20x. They also offer dividends. Sure, they're small, especially NVIDIA's, but they are growing because these companies are generating massive free cash flow.
Now, seeing those massive market caps, you're probably wondering, wait, is this just another dot-com bubble? The data emphatically says no.
During the dot-com bubble, companies were rocking PE ratios of 70x or higher, and it was based entirely on pure speculation and website clicks. Today's AI boom features forward PEs in that very reasonable 20 to 26x range, and more importantly, it is backed by accelerating record cash flows and real insatiable enterprise demand. It's a completely different ballgame. Let's zoom in on NVIDIA for a second, because they are absolutely crushing it. They are the undisputed king of Layer 1 infrastructure, specifically with their AI GPUs. The data notes their recent fiscal revenue projections are hitting roughly $115.9 billion. That is up 65% year over year. And while their trailing PE might look a little high at first glance, their earnings growth, which has literally exploded by over 100% in recent periods, rapidly compresses those forward multiples. Plus, they aren't just a hardware company anymore. Their CUDA software creates this massive ecosystem moat. Because developers are building directly on this software, it basically locks them into NVIDIA's platform, making it incredibly hard for competitors to just swoop in and steal them away.
Next up, we have Microsoft. If NVIDIA is the ultimate growth engine, the sources highlight Microsoft as the massive, stable anchor for your AI portfolio. They boast a fortress balance sheet with nearly $318 billion in trailing 12-month revenue. Microsoft is brilliantly positioned because they're integrating OpenAI's tech directly into their systems, embedding AI copilots into software that people are already using every single day. Combine that with massive growth in their Azure cloud computing segment and a really reliable dividend, and you get a relatively lower risk entry point into the AI revolution.
All right, Section 4, your beginner investment plan. Let's talk about the actual actionable steps to safely build your portfolio.
So how do you actually get started? Here's your mechanical blueprint. Step 1. Open a low-fee brokerage account. Step 2. Start with broad tech or AI exchange-traded funds, or ETFs. These funds hold a big basket of many stocks, which instantly diversifies your risk. Step 3. Utilize fractional shares. This lets you buy into expensive leaders like Microsoft without needing hundreds of dollars upfront. And Step 4, which honestly is absolutely crucial, dollar cost average. This just means investing a fixed amount of money consistently over time, rain or shine, whether the market is up or down. It totally takes the emotion out of investing and dramatically reduces the risk of buying in at the wrong time.
So what does this actually look like in practice? For a beginner aiming for a really balanced structure, the research suggests an allocation kind of like this. Put 50% in broad tech and AI ETFs for foundational stability. Then allocate 30% to those individual dominant leaders we talked about, like Microsoft and NVIDIA. Finally, set aside a 20% slice for international diversification, maybe international semiconductor manufacturers, just to make sure all your eggs aren't sitting in one regional basket.
And finally, Section 5, Risks and Realities, because we have to talk about protecting your investments.
The data sources are super clear on this. No investment is guaranteed, and you absolutely have to be aware of the hurdles. First, valuation corrections. Because expectations are so sky-high right now, even a tiny miss in an earnings report can cause a big stock price pullback. Second, macro factors. High interest rates or a broader recession can easily slow down all that massive corporate spending. Third, tech evolves incredibly fast. The winner today has to execute flawlessly just to beat tomorrow's competition. And lastly, regulation. Governments are actively scrutinizing data privacy, ethical AI use, and the massive energy footprints of these data centers. We bring these up purely to give you the full neutral picture. Every sector has headwinds, and AI is no exception.
So how do you mitigate those risks? You keep it rational. Aim to allocate just 5 to 15% of your total overall portfolio to AI specifically as you start out. But more importantly, commit to a 5 to 10-year horizon. Listen, this is not a get-rich-quick scheme. It's a long-term play on a massive, fundamental economic shift.
And that brings us to our final thought. We've seen the data. We've seen those $22 trillion global economic impact projections. The AI revolution is compounding value at an extraordinary rate, quite literally building the infrastructure of tomorrow. So the big question the research leaves us with is simple. Are you going to watch this play out from the sidelines, or will you use this knowledge to step in responsibly? Thank you so much for joining me on this explainer. Keep learning, keep researching, and as always, let's keep turning knowledge into understanding. Catch you next time.